Chelsea Football Club won the Premier League for the very first time in its history, it wasn't the attacking strength of Lampard and Drogba that got us that trophy, but it was our sturdy defensive formation of Terry, Carvalho, Ferreira, Makelele, and Petr Cech on the line, who allowed just 15 goals in an entire season of 38 matches. 2004-2005 was a special season for the club, and not just because we had a special manager.
I'm European champion. I think I'm a special one.
It was special in the way the club showed to the entire world that while a good attack can win you games, it's a strong defense that wins you titles. Now, the investing version of this, especially around equities, is what is generally referred to as defensive stocks or a defensive portfolio strategy. In fact, I've already discussed one such type of portfolio on my channel, an all-weather portfolio. And in this video, I'll further that discussion with a focus on building a defensive strategy that offers more stability to our equity portfolio, has inbuilt resistance to face economic downturns comfortably. The expected volatility of this portfolio is on the lower side, and most importantly, this portfolio should offer above average stock market returns. I think it's a very relevant video at this time of uncertainty, and I'm just jumping the gun here. But just like how Chelsea won a bunch of trophies when Mr. Abramovich was the owner for 17 odd years, I'll also be presenting an investing sequence of defense and offense that anyone can implement and over the last 17 years has delivered a post-tax annual return of 20%. वो टेक्निक मैं आपको हाफ टाइम के बाद बताऊंगा, but for now, let's begin. So simply said, a defensive business is one that produces goods and services that people continue to consume even during economic downturns. And what are these goods and services? Well, I'm sure you're aware of most of these, but just to categorize it, we're looking at utilities like electricity, water, a gas connection, etc., which are essential for daily life, and therefore there are no significant declines in its usage during downturns. Next, we have healthcare services like going to a doctor, treatment, surgery, medicines, etc. Education, and in spite of economic challenges, this is something that most families prioritize. Then there's definitely personal care, and products like a toothpaste, soap, shampoo, face wash, etc. are always there. The list also includes household goods like cleaning supplies and kitchen essentials that are needed to maintain a functional living space. And finally, telecommunications like your mobile plan and an internet connection, which have now become important items for one and all. So essentially, this is criteria number one, that is, look for sectors whose revenues are less susceptible to economic fluctuations, that is, they are not cyclical in nature, which is why these defensive stocks are also referred to as non-cyclical stocks. And understandably, this includes companies like HUL, Asian Paints, Bharti Airtel, Avenue Supermarts, and so on. Now, in terms of identifying these companies on a screener, different platforms have their own interface. But if you're using screener.in, then simply tap on the industry button to see and select different options. And if you're on Tickertape, then there's a sector dropdown that one can always use. A second way of identifying such non-cyclical stocks is to look at what is called the beta of a stock. So a stock's beta is very simply a measure of its volatility, and although this formula looks extremely scary, all I want you to remember is that defensive non-cyclical stocks have a low beta, which means these stocks are less volatile than the broader market like the Nifty 50. And just as an example, if the market falls by say 10%, then because Hindustan Unilever is at a low beta of only 0.19, it should, at least on a historical basis, fall by only 1.9%. So low beta indicates low volatility, and although this number does change over time, it's common knowledge that non-cyclical stocks have a low beta, a beta of less than 1, which theoretically means by including such stocks, you can reduce the overall risk of your portfolio. In addition to stable demand, resilient earnings, and a low beta, non-cyclical stocks also have a history of strong, consistent, and rising dividends. They tend to maintain a strong balance sheet with low levels of debt, which helps them weather economic downturns more effectively. And finally, these companies also exhibit market leadership with established brands and a dominant market position. Which brings us to the question, how can one invest in these non-cyclical stocks and how would that portfolio perform? The first approach is synonymous with the coffee can style of investing. That is, you take a bunch of 15-20 stocks that are defensive in nature, you put an equal amount of money in each of these stocks, you sit on it for a few years, and hopefully some of these stocks would have done really well and would have given you a nice, big, delicious return on your portfolio. For example, and based on the 4-5 characteristics I've discussed earlier, here's a quick list of 30 companies I have compiled, and I'm sure you'll recognize most of them, if not all these 30 companies. companies. In terms of performance, the stock portfolio has done really well over the last 5, 7, 10-year period as compared to the Nifty 50, and even when examined on an annual basis, our randomly picked non-cyclical portfolio has done a lot better than the Nifty 50 in most years, which is good evidence that a defensive portfolio can, and it normally does, turn out to be an aggressive performer. Of course, this list of 30 stocks can be made a lot better, and I've already taken you through a number of investing strategies on my channel, and I hope by now you have understood and adopted the best parts of each strategy and you have a customized screener query for yourself. So this was more of an active style of investing. That is, one needs to keep track of numbers, change allocations, rebalance, etc. But what if there was a passively managed portfolio solution to all this? Okay, I might have said it more like a question, but it's more of a statement because there actually is an index that does all this, and it's called the Nifty Non-Cyclical Consumer Index. This index was launched a couple of years back, and as the name suggests, it tracks the performance of a portfolio of stocks that broadly represents the non-cyclical consumer theme. Alright, so let's start with how the index is constructed. And step one is to identify certain basic industries from this long industry classification document that's available on the Nifty Indices website. Now, because we know the kind of companies we need within this scheme, the index focuses on specific sectors like consumer goods, telecom, media, services, entertainment, textiles, FMCG, and related industries that are consumer facing. The next step, step 2, is where the 30 largest companies from this list are selected, which as a methodology is done on the basis of the stock's 6-month average free float market capitalization, which as of today gives us a list of these highly recognizable companies, which is then reviewed on a semi-annual basis in the months of January and July each year. Step 3 is where a certain weight is assigned to every stock within the index, which is again based on their free float market capitalization. This part is important, and as I have illustrated in some of my previous videos, and just as an example, while the Titan Company Limited and Avenue Supermarts have more or less a similar market capitalization, but because their free float percentage is a lot different, there is a striking difference in the weightage that's been assigned to both these companies. And the fourth and final step in the construction process is the management of risk, and the Nifty Non-Cyclical Consumer Index does that by capping the weightage of each stock to a maximum of 10%, which is why you see Hindustan Unilever not crossing the 10% mark from this current list of constituents. Okay, now that the logic behind having this index and the construction of it has been defined, let's examine some of the performance numbers to see if investing in it makes any sense or not. Now, on a broad basis and over different time periods, the Nifty Non-Cyclical Consumer Index has definitely done better than the Nifty 50 and also the Nifty 500, with a total price return of 16.2% since the start of this index in April of 2005. But where this analysis becomes really interesting is when we start comparing these returns on an annual basis. You see, the first thing one might notice is the consistency of returns. I mean, look at these numbers from the start of 2011. 20.4%, 23.9%, 32%, 18, 21, 25, 24%, and so on. Now let's map the Nifty 50 returns, and one can see the inconsistent nature of it, with returns going as high as 76% in 2009 and as low as minus 52% in 2008. In fact, 2008 is particularly interesting because while the Nifty 50 lost half of its value in that year, this non-cyclical index, this defensive index, actually gained 4.6% in that same shambolic year, which is an excellent demonstration of the stability of this index, its low volatility, and its ability to absorb economic downturns. Okay, now that I've mentioned volatility and downturns, remember the concept of beta I explained earlier? Well, this is very much visible with the Nifty Non-Cyclical Consumer Index. You know what? Let me just call it NCCI from now on. So the NCCI's beta relative to the Nifty 500 averages around 0.78, which believe me is a fantastic number and is a strong diversification tool, especially if your portfolio is loaded with large caps and mid caps. Yet another interesting pattern I observed in this data is on how the NCCI and the Nifty 50 seems to alternate in performance on an year-on-year basis. For instance, the Nifty 50 delivered better returns in 2006 and 2007, only for the NCCI to outperform by a huge margin in 2008. This was followed by the Nifty 50 in 09 and 2010, NCCI in 2011, Nifty 50 in 12, back to NCCI in 2013, and so on. The irony of this pattern is that I found a sort of cyclicity in a non-cyclical fund which I thought was quite amusing. But more than just looking at it as a pattern, I think we can also convert this into a solid investing strategy, and here's how. So suppose I had a lakh of rupees to invest towards the end of say 2013. Now on the 1st of January 2014, I look at the previous year's data and I see that the NCCI was the better performer last year, which means for this year, that is in 2014, I'll assume that the alternate index, that is the Nifty 50, will probably do better, and I go on to invest that lakh of rupees on the Nifty 50 index. As luck would have had it, or rather my acute sense of pattern observation would have had it, the Nifty 50 did do a lot better than the NCCI, and my 1 lakh investment jumped by 31.4% in that year. Now, because the Nifty 50 was the better performer in 2014, my 2015 investment will need to go in the alternate index, that is the NCCI, and thankfully this also turned out to be a wise move, because while the NCCI rose by 21.8% that year, the Nifty actually lost some 4% in value. I hope you can see and understand what I am up to. I'm basically trying to play the odds that if the Nifty 50 does well in year 1, then probably in year 2, it's going to be the NCCI that delivers better performance and vice versa. So essentially, this is nothing but a super simple system that I've created on top of the two index funds that show a contrasting performance pattern. And when applied from 2014 until 2023, this method would have converted my 1 lakh rupees into 6.6 lakh rupees, that comes to a pre-tax 10-year CAGR of 20.8%. Now 20% obviously looks good, but because I am switching 100% from one fund to the other in most years, it won't be right to ignore the capital gain tax in this case. But before I come to that, notice I purposefully took 2014 as a starting point and not 2006 or 2007, as I felt it might have corrupted my study. However, just to close loop this, the same 1 lakh, if I had invested it on the 1st of January 2007 and had applied the alternating sequence that we just learned, the returns would have come a little bit higher, giving me a 17-year pre-tax CAGR of 21.7%. In fact, even after paying an LTCG of 10%, this method gives me an annualized return of 19.9% over a 17-year period, effectively turning my 1 lakh rupees into 21.7 lakhs, which is excluding dividends and definitely something that is worthy of our consideration. If you want to have a crack at it, make some modifications perhaps, then please feel free to use the worksheet that I've attached to the video's description. Alright, so if you're convinced that the NCCI deserves a place in your portfolio, or if you want to allocate some money as an experiment, then pleasantly there are a couple of options that are available today. Actually, not two. There's only one scheme at the moment, the HDFC Non-Cyclical Consumer Index Fund, but then Grow has also filed for it and the NFO should be out any day now, so have a look at that as well. In terms of who should invest in this fund, it is definitely for investors who are looking for stable and consistent returns, and I proved this part with the year-on-year numbers. And this index should also appeal to anyone who has a relatively lower risk tolerance. But that doesn't mean there is no risk in this. In fact, the NCCI has every risk that one can associate with any equity investment, but just to highlight a couple of them. Firstly, there will be periods where this consumption theme might not do as well as other sectors or the broader market in general, and this has been the case for the last 3 years or so, ever since COVID happened. And the second big risk comes when money is being put on a lump sum basis, because the consumer theme in India generally has a high valuation, a high P ratio, which makes the timing of entry and exit very crucial if you want to purely focus on this scheme. To put numbers to this, I mapped the P ratio of the last 2-3 years, and although there seems to be some kind of a plateau around the 60 mark, nevertheless one will still need to be careful with the valuations, especially if you're opting for the lump sum mode and if you're not keen on holding on to your investment for a decent period of time. So to put this all together, the NCCI, that is the Nifty Non-Cyclical Consumer Index, offers investors a relatively stable way of participating in equities. It comes with low volatility as evidenced by its low beta and is recession-proof to a large extent. This index historically offers better returns as compared to a broad market index like the Nifty 50 or the Nifty 500. I put forth a very interesting investing pattern, and I hope some of you will take this up as an experiment and hopefully earn a post-tax return of 20% for the rest of your life, I hope. And finally, on a more macro basis, the consumer sector has massive tailwinds in India with rising GDP per capita, leading to higher expenditure, a young population, urbanization, a growing organized sector, and a lot more. I sincerely hope that you liked this presentation. You found it informative, useful. Once again, thank you for your time. Do subscribe to my newsletter if you haven't done that yet, and I'll see you next week. Until then.